Welcome to The Explainer. I am absolutely thrilled you're here today because we're putting on our detective hats. We're going to look at the financial markets not as, just chaotic squiggles on a screen, but as a highly engineered machine. Have you ever wondered how massive financial institutions actually trade? Well, today we're decoding their exact methods. We're breaking down what's known as smart money concepts, and we're going to uncover the hidden logic behind all those market movements.
BOSS, CHOCH, FVG, OB, ITH, ITL. Are we learning how to trade here, or are we just making a giant bowl of alphabet soup? I totally empathize if this wall of acronyms feels, well, a little overwhelming right now. It is a lot. When you first step into the world of smart money concepts, it honestly feels like everyone's speaking a completely different language. But hey, don't worry, we're going to translate the whole shebang for you today.
Okay, let's dive into this. First, we'll tackle the trading alphabet soup. Second, mapping the market structure. Third, liquidity, which is the market's fuel. Fourth, tracking institutional footprints. And finally, finding your daily bias. We're going to decode all this chaos into a logical, mechanical system that you can actually use.
So moving to part 2 on our list, mapping market structure. Before you can navigate anywhere, you really need a map, right? In trading, mapping the market means identifying structural turning points, your intermediate, short, and long-term highs and lows. These points are basically the load-bearing pillars of the market structure. Now, how do we know if our map is telling us to keep going or to turn around? That's exactly where BOS and CHOCH come in. A BOS, or break of structure, is your green light. It means the market moved in one direction, gave a little pullback on the last swing, and then powered right through to break that last high or low. The trend is continuing. But a CHOCH, a change of character, that's your glaring red warning sign. This happens when the market suddenly changes direction and breaks the last structural low or high on the opposite side. Basically, a BOS tells you to stay the course, and a CHOCH tells you the winds have suddenly shifted.
And the absolutely beautiful thing about this map is that it scales perfectly. The market is entirely fractal. What that means is the exact same patterns, the exact same nature of movement, they happen across all time frames. A trend on a weekly chart looks identical in structure to a trend on a 1-minute chart. So, if you're analyzing a higher time frame and you just can't find your structural setup, don't force it. Because of this fractal nature, you can seamlessly shift to a lower time frame and find those exact same breaks of structure and changes of character waiting right there for you.
Let's move to our third piece and see how this builds. Liquidity, the market's fuel.
If market structure is the map, liquidity is the literal engine that drives us from one point on that map to the next. The market mechanically drives toward specific zones to fill orders. So where is all this fuel stored? Well, it rests in specific target areas on your chart. It sits above swing highs and below swing lows. It hangs out at the previous day's high or low. The market treats these levels as literal fuel stations. To power its next big move, price action just has to target these areas to sweep, tap, and grab that liquidity. Whether it's external or internal, the market is constantly hunting these zones to fulfill the massive orders of the big institutions.
But here is where the market gets incredibly sneaky. Enter inducement, or IDM. Inducement is a trap. Plain and simple. It's that tempting final pullback that the market deliberately creates to trick early traders into jumping in. Once retail traders place their stop losses just behind that pullback, boom, the market sweeps right through it, grabs their liquidity as fuel, and then sails off in the original direction. I want you to think about your own charting for a second. Have you ever been perfectly right about the market's direction but still got stopped out right before the massive move happened? Yeah, you didn't misread the trend. You just became the inducement.
Which brings us to part 4. Tracking institutional footprints.
Now that we know where the market gets its fuel, who's actually doing the driving? We need to track the massive, literal footprints left behind by institutional algorithms. See, when big money steps in, they do not tiptoe. They enter with such explosive volume that the market simply cannot match buyers and sellers fast enough. This creates what's called a fair value gap, or FVG. Picture a massive, rapid price imbalance just shooting across your screen. It's a literal gap left in the price action across just 1 to 3 candles. The delivery is incredibly fast, violently breaking away and leaving a gaping hole of unmitigated price action right in its wake.
Now, what's really interesting about this next concept is how we can trace that explosion back to its origin block on the chart. That origin? That's the order block. The order block is the specific final candle right before that explosive fair value gap occurred. It is the exact, undeniable footprint of that massive institutional player hitting the buy or sell button, and when the market eventually pulls back, it's returning to this exact block to pick up the rest of those massive orders.
Let's slow things down just a bit here. because not all order blocks are identical. For instance, a mitigated block has already been tapped by a pullback to the higher high of the last selling candle, which kind of makes it less accurate for future use. A breaker block is highly aggressive. It sweeps liquidity on both sides before moving. Then you have rejection blocks, where the price violently taps with a wick, but the body doesn't close over the last swing, just a quick tap and go. And finally, reclaimed blocks, where a shifting trend taps a point of interest only to reverse and reclaim the previous left swing's order block.
To actually trade these footprints, the pros don't just guess where inside the block to enter. No way. They measure them precisely using Fibonacci zones. Depending on the setup, you might stretch your fib tool across just the wicks of the order block, or across the body and the wicks. You're basically mapping the 0 to 0.5 to 1 levels to find the absolute perfect premium and discount entry zones. You want to buy deep in the discount zone and sell high in the premium.
When you start stringing these footprints together, you get order flow. Order flow is simply the visual path of a trend pulling back, tapping into a fair value gap or an order block, and then just continuing on its way. It's the market moving along the path of least resistance. It's literally stepping directly in the footprints of the institutions over and over again.
And finally, part 5, finding your daily bias.
So, let's recap real quick. We have our map, we understand our fuel, and we can absolutely track the footprints. But to navigate all of this, we need a daily compass. You find this by checking how the higher time frame daily candle is created to confirm your bias well before dropping down to the lower time frames to execute. So the crucial point is this: if the higher time frame creates an open, then drops to form a low, rallies to a high, and then closes near the top, that's an OLHC profile. You have a strict bias to the upside. Conversely, if it opens, pushes up to a high, drops sharply to a low, and closes near the bottom, an OHLC profile, your bias is absolutely locked to the downside. This simple rule dictates entirely which way you should be trading for that session.
And this brilliantly illustrates how everything comes together into a final point of interest or POI checklist. Step 1. Identify your structural swing highs and lows. Step 2. Check for that aggressive institutional displacement creating a fair value gap. Step 3. Analyze the higher time frame trend for your bias. And step 4, zoom into the lower time frame to actually enter the trade. Oh, and remember this golden rule of smart money concepts. Within a single trend, the very first and the very last POIs are always the most historically accurate.
Well, we've successfully translated the alphabet soup. You now know exactly how to draw the map, spot the traps of inducement, and find the exact blocks where massive institutions leave their mark. The market is a machine, and you now hold the literal blueprint. So I'm going to leave you with this. Now that you can clearly see the footprints right on the chart, will you patiently wait to follow the smart money, or will you let your impatience turn you into the market's liquidity fuel? The choice is entirely up to you.